As you all know, the fund is well known, particularly right now, for its financing role in the context of crisis resolution. But it also monitors the policies of all of our membership. And this monitoring role, which is, Fred has indicated, is referred to as surveillance, is pretty central to the fund's role in terms of crisis prevention. And I think there's a recognition that the fund could have done a better job in anticipating the 2008 crisis. And this recognition motivated a relatively comprehensive review of the fund's surveillance function. So among the recommendations that came out of this review, and I assure you there were a number of recommendations for reform, one of the recommendations focused on the reform of the legal framework that underpins fund surveillance. And this is not a narrow issue because this legal framework defines the content and the scope of the analysis that fund brings to bear when it's assessing members' policies. And there was a sense that this framework was really out of sync with the economic realities prevailing in an integrated global economy. So if I can just give you a very brief background on the legal basis for surveillance, essentially what is referred to as bilateral surveillance is an assessment by the fund of members' economic policy obligations that they incurred when they became members of the fund. It involves, first, an analysis by staff, second, a discussion with the authorities on the basis of that analysis, and third, a peer review at the executive board. And there was a sense that this framework had two particular limitations when it came to the treatment of spillovers, the point that Fred has emphasized. Now, the first one of these limitations is perhaps technical. The second one is more profound. The first is that the underlying assumption was that when it came to members' domestic policies, that the spillovers arising from those policies on the rest of the membership would be transmitted through that member's balance of payments, including its exchange rate. And there was a sense that that assumption proved incorrect in the context of the 2008 crisis, because while, for example, the instability in the US financial system did have profound spillovers, it was really not instability that was transmitted through the US balance of payments. The second and more fundamental limitation, again, relates to domestic policies. And it is that members' domestic policy obligations are more limited than their obligations with respect to their external policies, including exchange rate policies. What do I mean by this? With respect to external policies, members are always responsible for the adverse spillover effects of these policies. However, with respect to domestic policies, members are only responsible for those spillover effects to the extent to which these domestic policies create domestic instability. In other words, as long as a country is keeping its own house in order, it is not responsible for any of the adverse consequences of those policies. As Tam will point out, the reality is that domestic policies, even though they have no adverse impact on domestic stability, can have significant adverse spillover effects, and he'll come up with a couple of examples of that. And because they were limited in this respect, Article 4 consultation reports did not discuss those. They were not permitted to discuss those because the purpose of the exercise was to discuss members' obligations. So, how to fix this problem? The first problem, which is the transmission problem, was easy to fix because essentially it was a limitation that found its way into an executive board decision in 2007, and the executive board could remove it. The second problem is a deeper problem because it arises from a limitation in the fund's charter, the Articles of Agreement. And it reflected a view prevailing at the time of the Second Amendment that with respect to their domestic policies, members surrendered less sovereignty to the international community than they did with respect to their external policies. So the only way to fix this problem at its core was to amend the Articles of Agreement, an exercise that was considered not only to be a long undertaking, but one where it was unlikely that we would be able to get the needed political support. So we looked around for alternative solutions. And we addressed it by looking at another source of authority that the fund is given, which is what we call multilateral surveillance. So in addition to being responsible for overseeing members' obligations with respect to their economic policies, the fund is also charged with overseeing the effective operation of the international monetary system more generally. And until now, this authority has been exercised through analytical products, the World Economic Outlook, the Global Financial Stability Report. However, there was nothing stopping the fund from using this authority to also engage on a consultation with members with respect to the adverse spillover effects of all their policies, to the extent to which it was judged to actually affect the international monetary system. So, with what we now refer to as the integrated surveillance decision, our annual Article 4 consultation reports become an exercise of both bilateral and multilateral surveillance. They will discuss spillovers on all domestic policies to the extent to which they have an adverse impact on the system. And more specifically, this discussion will take into account the views of the recipients of those spillovers. So an Article 4 consultation with country A will involve discussions not only with country A, but country B, C, and D to the extent to which they have received some impact. Now, it's important to recognize that this does not address the legal asymmetry, because with multilateral surveillance, members do not have an obligation to change their policies, only to engage in a discussion. So the legal asymmetry between domestic and external policy obligations still exists. The judgment was made, however, that in terms of the ultimate objective, which was traction for fund surveillance, it was more important to at least have an analytical framework that would look at all of the issues, even if it basically did not create obligations. But secondly, some members felt that it was critical that these reports covered all those issues because they felt that the lopsided coverage created a degree of discrimination and unfairness with respect to the attention on external policies. And there was a sense that addressing that problem would go a long way in creating greater ownership and surveillance and therefore enhancing traction. So I'm going to turn it over to Tam, who's going to give you some examples of how, in fact, this is going to look in practice, and also look at a new multilateral surveillance product called the External Sector Report. Thank you.
Thank you, Sean. So, as was just said, I'm going to start by talking a little bit about what, in practice, the integrated surveillance decision might allow one to do, and I'm going to do that via 3 examples. So, remember that the basic idea of the integrated surveillance decision is you can bring multilateral into bilateral surveillance. So, where I'm going to give you 3 examples of policies which would have been much more difficult to cover under the past. The first, this is just a summary of the integrated surveillance decision. The first has to do with financial market linkages. So here I've got some of our analysis of interconnectedness, and this has to do with the BIS banking statistics. So this is about ownership of assets abroad of different banking systems. And you can see there are a number of nodes, but that there's one which is much bigger than all the others. And that one turns out to be the UK. So UK financial policies clearly have an impact not only domestically, but also on other countries, both through UK banks being in other countries and other banks being in the UK. Now, to the extent that so here is an example of something which goes not through the balance of payments, but more through balance sheets and asset prices. So if the UK changes its financial regulation, it can have effect on the rest of the world, which is not going through the balance of payments. So here's an area where, in the past, we would have been only able to talk about UK regulation as it affects the UK economy, and now we can bring in how it might affect the rest of the world. So this is an example of a policy which didn't go through the balance of payments. And here you can see why this matters. We've got also in this interconnectedness analysis a graph of a financial shock in the UK and the US. And because the US system is much more domestically orientated than the UK financial system, there are bigger and faster effects from the UK. Let me now turn to a second example, and this has to do with Chinese rebalancing. Now, this example has to do a policy which doesn't create domestic instability, but can affect the rest of the world. So here, what we're going to do is we're going to do a thought experiment where the Chinese manage to rebalance their domestic demand by magically reducing their investment by 1% of GDP, and at exactly the same time raising their consumption by 1% of GDP. Okay? So the impact on China is zero, and therefore there's no domestic instability. But of course, because investment in China is much, much more trade intensive than is consumption, at least at present, if you did this very quickly, you could have a negative impact on some trading partners. I've shown you some estimates here. And also since investment's much more commodity intensive, again, in China than is consumption, you could also affect commodity producers through lower commodity prices, and I've got some estimates here for you. So here's something where you weren't creating domestic instability, but you could affect the rest of the world. And this is part of the background to our advice that you should plan rebalancing, but achieve it at a reasonable pace rather than very quickly. So the third example I want to talk about is the US fiscal cliff. And what I want to do here is talk about how the discussion with partner countries can matter, especially given the circumstances. So here is, let's say the US simply lowered its fiscal policy, its fiscal deficit by 4% over 1 year. Okay, I've got a standard simulation showing what the spillover effects are. They're what you might expect. They're mainly in NAFTA, a few other countries, and then for the rest of the world, the effects are somewhat smaller. But of course, in current circumstances, you'd expect these spillovers to be larger, for at least two reasons. The first is that there's very little policy space in many countries, not only the US, but also in Europe, the UK, Japan, many other countries. And the second is, this simulation implicitly assumes that this lowering of the US fiscal deficit is good for markets, that markets feel sort of comforted by the fact that the deficit has gone down. However, if the US fiscal cliff comes about, you might think that actually that would create more uncertainty in markets, since the inability of the political system to come to an agreement would be regarded as a negative. So we've done a simulation in our spillover analysis showing how much bigger those spillovers might be, and that's the result. So the point about this is we can now go and talk about these bigger spillovers to the US as part of our discussion about the risks from the fiscal cliff. So there are three examples of how the integrated surveillance decision in practice can bring the multilateral into the bilateral and expand the way that we talk about the world. What I'd like to do now is turn over to a second product. This is actually, as Sean mentioned, actually a multilateral product called the External Sector Report. And the idea of this was to look at current accounts across the world in an integrated way, looking at not only current accounts, but also real effective exchange rates, also reserves, and capital flows, and balance sheet positions. And I'm just going to highlight a couple of pieces of the analysis. So why did we do this external sector report? Well, one reason that we did it was we were asked to do more analysis on external sector, so we decided to write a report. The second is, but this is very important, that the reason that I think that this is sort of linked to this integrated surveillance decision is, although it's a multilateral report, it involved detailed discussion with 28 of our teams on the largest 28 countries in the world. So it's a report which includes both multilateral analysis and detailed discussions with each of the teams. And the final outcome was an agreement between the multilateral analysis and the bilateral analysis, and those came together. So, as an example, what's in the external sector report, if the Article 4 was published on the same day, you'd expect exactly the same analysis to form the basis for the external sector analysis. It might be written differently because the reports are for different purposes, but the analysis would be the same. And as we will discuss later, my colleague Steve will discuss, it examines the consequences of desirable global policies. And what very important is that this was a pilot exercise, and we are looking forward to feedback on it. So here's a quick look at some simple facts, which is here's the rise in current account divergences through about 2007, and then a partial coming together since, partial reduction. One of the things that we did was we looked at how much this was cyclical and how much this was due to policies, and our analysis suggests that much of the reduction has actually been due to the global recession rather than policies. So our own prediction is that global imbalances, absent further change in policies, will be likely to widen out again. In the middle, you'll also see that we have the euro area surplus countries, that's the light blue, and the euro area deficit countries, which is the sort of pink. Now, one of the things that we did in this report was also to look at imbalances within the euro area. So let me focus on those for a second. Exactly the same pattern. Indeed, eerily similar numbers. It rose from 1.5% of GDP around 2001 to about 3% and has come down. And exactly the same basic analysis, here you can see who's involved, but exactly the same basic analysis that much of the reduction thus far in imbalances was due to the recession remains true of this as well. Now let me go through some of the analysis that we did. Here you see current accounts for 10 regions in the world as a ratio to their GDP. That's in the blue, and private capital flows is in the white. So as you can see, if you look at the left, we've got 10 regions and we're ordering them by the size of their current account surplus or deficit. On the left, you have a pattern that looks reasonably intuitive, which is the countries that had large current account deficits also had private sector inflows. That's sort of what you would expect. As you move to the right, with the important exception of oil exporters, the pattern looks slightly less intuitive, in that you've got countries who are running current account surpluses and either have very small capital outflows or actually private sector capital inflows. How is this possible? Well, of course, the balancing item is the change in reserves, and here you can see the change in reserves for these regions. Now, this is only for 2011, so you might say, well, has this really been a pattern, this slightly surprising result? And the answer to that is yes. Let me show you the international investment position for these regions. Again, on the left, you've got private sector indebtedness, and as you would expect, countries who are running current account deficits tend to have private sector indebtedness, offset, but only to a quite minor extent by reserves. On the right, you've got the countries who've been running current account surpluses. What you can see is, with the honorable exception of Japan, private sector is still in debt, despite these current account surpluses. And the reason, but this is in most cases more than offset, not every case, but in most cases more than offset by higher reserves. So the final question you might ask is, well, the world is an uncertain place, are these levels of reserves appropriate or not? And here we have our own reserve adequacy measure that we've published and discussed. And this was one of the parts of the report. And here you can see our estimates as a percent of the IMF metric. Now, our preferred suggested adequacy range is from 100 to 150, and this is based on analysis of how much reserves have been useful for countries who, in times of crisis. As you can see, while one is below and several are in the middle, quite a few countries are on the right-hand side and seem to be above the metric, suggesting that reserves may be an issue. Let me turn to two other things, one of which is it's the nature of capital flows. The first is, here's a graph of equity flows into emerging markets. As you can see, there's a distinct change around the time of the crisis from being relatively stable to quite unstable. Now, part of this we do think is due to simple financial market instability, uncertainty about the future of the financial system, which would cause significant flows in and out of countries. And you can certainly see that around the Lehman event and around the euro area crises, there has been more volatility. But in addition, it's difficult not to come to the conclusion that at least part of this has to do with large amounts of liquidity and zero interest rates in the major countries who are supplying liquidity to the rest of the world. And it would seem very sensible to assume that at least part of this increase was due to that. And that's what we conclude in the report. A final thing is about the composition of emerging market capital flows. And here you can see a picture showing debt-creating flows in light blue and equity flows, which is FDI, and equity portfolio flows in dark blue. What you can see is during much of the 2000s, the flows were actually into equity and out of debt-creating flows, which reduces vulnerabilities. However, more recently, there's actually been a big increase in flows into debt-creating instruments, which in and of itself could create vulnerability. So, what's the bottom line of all of this? Well, the bottom line is we produced for every country in the sample, so all 28 countries, and we published this picture of the current account that they're running versus one that we think is appropriate given fundamentals and desirable policies. So we define desirable medium-term policies for every country in the world, and we calculated what the current account based on fundamentals and those policies should be, and then we calculated the divergence. As you can see, these are ranges, because we're certainly not certain about these numbers. So there's an estimate, and you can just go through to your favorite country, but all 28 countries are there. And we did this both for the current account, and we did it for the real effective exchange rate. And there's one thing, I said that we combined bilateral and multilateral. I want to just finish by noting the yellow versus the blue bars. So the blue bars are non-EMU countries, and the yellow bars are EMU countries. And if you compare the current account deviations and the real effective exchange rate deviations, what you can see is that by and large in EMU, the exchange rate deviations are smaller for the same current account deviation. Well, why would that be? Well, of course, one of the worries that we've had in the euro area is how difficult it is to change relative prices within a currency union. But there's another factor that one needs to remember, which is because relative prices are more sticky, by and large, trade tends to react more to them. Because, you know, if I'm trading and I'm in New York and I have a 5% advantage against California and a 10% advantage against Toronto, I'll probably trade with California because I know it's going to be there tomorrow. So this is one of the ways in which we think that we've put the country-specific analysis in. Now I'll let my colleague talk about the technology behind some of these calculations.
Thanks, Tim. I'll fulfill my duty of talking about the technology, but I'll try not to bore anyone. I know it's not a technical seminar. I just want to give you a feel for the external balance assessment methodology, which we're calling EBA or EBA. Maybe not the best acronym, but we'll give you a sense of that and then show some more in-depth charts. And basically, what is EBA? It's a tool. It's an enhanced version of a tool that we had before at the IMF for analyzing current accounts and real exchange rates. So it's our business to go around and say whether we think a current account is too high or too low, a real exchange rate is too high or too low. And we identify gaps, so gaps of the type that Tam just showed you a minute ago. What we're doing with it in this exercise is we're doing something that's consistent. It's multilaterally consistent because we're not analyzing one country at a time. We're taking 50 economies, actually, even larger than the group that, including the group Tam just showed you, but even larger, covering about 90% of the world, and we're analyzing them all at the same time and relative to each other, and that's essential because we all know that current accounts depend on not what's happening only in your own country, but relative to everyone else. It's a key input to IMF surveillance. It's under development, so we have to say it's not the final word. It's not, we in the research department who are producing this methodology don't expect anyone to take our final number and just sign off without looking at it. We expect people in the IMF and we expect people like you to respond to it. In fact, we're seeking feedback on the entire methodology, which is in a pilot stage. Luckily for you, in terms of technical details, there's a technical background paper, so I won't turn this into a seminar, and very soon, about 2 weeks from now, all the details of our numbers, data set, et cetera, will be available for those of you who are interested in that kind of thing. What are the big advances of our new methodology relative to what we were doing before? Well, essentially, we're doing a richer story of current accounts and real exchange rates. We're looking at more policies. For example, now we have reserve accumulation and capital controls policies incorporated explicitly into the analysis. And I should note they actually interact with each other. So, for example, we have a reserve accumulation tends to increase a country's current account surplus. So does the imposition of capital controls, at least according to our index. And moreover, they interact. We actually find that when countries accumulate reserves, it has more of an effect on their current account if they have capital controls in place at the same time. So far in our work, and I know Joe will come to this, we haven't actually, what we found for countries that don't have capital controls in place, we haven't been able to detect much of an effect in that area, but that's an area for ongoing research. Another innovation in addition to fiscal policy is the traditional current account explanatory policy. We've got an index of social protection. And the idea here is that countries with very low social protection networks or nets provided by policies, in those countries, people have a very strong incentive to save for their old age, to save because they don't know how sick they'll be for how long at some point. The way we were able to proxy this is with public health expenditure. We tried a number of other things, but it turned out that the only one that we were able to get data for and that worked, and worked quite powerfully, in fact, is public health expenditure. I'll just briefly say that we are accounting for cyclical impacts too in the new model. Global swings in capital markets that change the way money flows between advanced economies and emerging economies. Moving back and forth depending on the state of the world. And we're bringing in the business cycle and commodity price cycles. All these things are difficult to do. That's why most people haven't been doing it much in the past. We're taking our best stab at it. Going back to the policies, the big innovation is that once we admit that policies have an influence on current accounts and real exchange rates, then we're forced to realize that unless we believe policies are always perfect, we have to take a stand on whether there exists what we're calling policy gaps. Is there a difference between a country's, say, fiscal policy today and where we think it should be in a medium term? That's probably the best example. And that's a policy gap. What we're able to do then is identify that impact or estimate that impact, and moreover, decompose it into whether the impact is coming from just one country itself or it's coming from other countries. This is a little illustration to illustrate that general point. Suppose we had just two countries in the world, they're country A and B, and they had only one policy, fiscal policy. Suppose fiscal policy in country A was fine, but fiscal policy in country B was wildly too loose. Well, we would all immediately expect that country B would have a current account imbalance, a negative one, and that's what's shown here. But if you think about it for a moment, that has to mean that country A, even though it has no apparent distortions in its policies, must have a current account, not only a surplus, but an imbalance, an inappropriately strong, in this case, current account because of someone else's policy distortions. That's a very simple but powerful insight, and we're able, as I say, to not only build this essential part of reality into our model, but to try to quantify which are each of the effects that are going on. This is just to show the happy case here when if country A maintains its good policy and country B corrects its policy, then the current account imbalances of both would disappear. So the sort of spillover from country B would be wiped out. Promise no technical seminar, so I'll just, for those of you who are interested, I'll just say, well, you're wondering, where does it all come from? How exactly do we do this? It all starts with a panel regression. We've got one for the current account and one for the real exchange rate. For time reasons, I'll just have to focus on the current account one today. But essentially, we've got a richer model than we had in the past. The current account not only as a function of things like demographics, income level, but of the kind of policy and cyclical variables I've already mentioned. Each of those things is measured for each country relative to all the others. That's again, very key. I'll just move very quickly on to say that after running this regression, the first thing we do is make a cyclical adjustment. We want to look at the cyclically adjusted current account to not be distracted by temporary factors. And then the really big step, we need to identify what we call a desirable current account. That's a level of the current account that's consistent with the country's fundamentals and with its policies being non-distortionary, not having policy gaps. We won't go into that, but it's essentially backing out that current account, that desired current account, based on numbers that came out of the regression and the key policy judgments about what are the appropriate levels, say, of fiscal policy, reserve accumulation, et cetera. What does this look like in practice? So these are the last, now we'll just have some charts, no more bullets. Let's apply it to 2011, as was done in the recent external sector report, current accounts. So these are the actual current accounts for the countries in that report, about 30. And you see they're very widely dispersed. There's a lot of variation out there. First thing we want to do is remove the cyclical component. So let's watch the little yellow diamonds move a bit. Please move. There they moved, okay? So your first reaction is it looks about the same. Okay, the pattern across countries is about the same, but for some countries, making a cyclical adjustment in some years can be quite important. So 1 or 2% of GDP is a big deal. The big step is use our methodology that I just outlined to say what we think is the desirable level of the current account. And this is removing the effect of the policy distortions and removing, importantly, distortions that aren't well captured in our model. As Tam has talked to that a bit about the other distortions. But then the next step is to look at the gaps between the actual cyclically adjusted and the desirable. We'll fill them in. The ones in yellow, the current accounts, are stronger than fundamentals and appropriate policies would imply, according to our estimate. And the blue ones are in the other direction. This is essentially the same chart that Tam showed you earlier, but they had ranges around it because after all, this is just a methodology. It produces a point estimate of gaps, and there's got to be some uncertainty around them. The one final selling point of this thing is a big one, is now those are the gaps. In the old days, the fund would say, well, that's the current account gap. It's too strong. That's it. Now what we're trying to do is dig inside that gap and say, well, what's actually driving it? So we zoom in, show a chart that shows just gaps. There they are, just the gaps. And then decompose it as best our methodology can into the constituent parts. So how much is coming from fiscal policy distortions, social protection policy distortions, capital controls and intervention policy distortions, all lumped together, and how much is coming from other essentially unexplained factors outside of our model. That we can do. I think it provides a richer story, and it gives some hints of remedies for current account gaps. The last thing I don't have a chart for it, but is to emphasize is that we can further break down these gaps, say the fiscal policy gap that's affecting country A's current account, into the part that's coming from its own fiscal policy and the part that's coming from the rest of the world's fiscal policy. That turns out to be very important right now. For a typical country now, let's say, for a country now that has no fiscal policy gap, that has its house in order, we estimate from this exercise that its current account balance is getting boosted by about 1.5% of GDP because of essentially fiscal profligacy around the world. Not in every country, but in very large, very important economies. So quite a few countries are having that kind of thing going on right now. That sort of multilateral aspect is really key to current account analysis, and it turns out to be especially important for fiscal policy right now. I'll just close by saying thank you and mentioning that there's one other aspect people often say, well, what about external sustainability? That remains a part of IMF analysis of current accounts. I just didn't feature it today, but it's an important part of we have essentially three legs of the EBA methodology, where we continue to focus on that. Is in some ways the first question with the current account is to ask, is it sustainable or not? Usually it apparently is, and then we move on to these sort of more advanced topics that we've tried to show you today. Thanks a lot.